There are others who teach, and at times the market itself will come close to the midpoint of these numbers. And so, therefore, they actually officially write down all the numbers and the midpoint of those numbers. So let's take a look at this. From R3, if we take a look at a given time frame, and then say this example, this is a bar chart. Let's say this is a day. This would be the low of the session. That would be where the session opened. That would be the high, and that would be the close. That's what that hash mark represents on a bar chart. Now, if we're using traditional pivot point, if the market closes closer to the high, remember, you're taking the high, the low, and the close, and adding them up, dividing by 3. Let's take a look at the effectiveness of the mathematical calculation of this formula. We've got two values closer to the high, the close and the high, and one down here, which is the low. By essence, if I add those 3 up and divide by 3, equally speaking, the pivot point is going to be a little bit higher than the actual midpoint of the range, right? So therefore, we're looking for an expansion of this range, and we're going to see R1, we're going to see R2, and R3 would be a way up here, a major expansion for the third resistance level. The opposite is true to the downside. If the market is truly bearish, of course, we're going to have the market have an expansion or extension of this overall range, and we'll see S1, S2, and S3. Now, if you have all these numbers and you draw the midpoint, remember, S3 midpoint, S2 midpoint, S1, then the midpoint to the pivot. Then you've got the midpoint, then R1, the midpoint, then R2, then another midpoint, then R3. And I write these numbers out. That's just way too many numbers, and it can lead to information overload. And again, information overload is what we call, or can sometimes interfere with us, as it leads to analysis paralysis. And that's the term often quoted that is associated by a trader hesitating when he sees a potential opportunity. He has way too much information. So using R3 all the way down to S3 with the midpoints, that gives us 13 price levels to monitor. Now, friends, think about this. If that's just one day, and we're using weekly numbers, that gives us 13 plus 13. Now we're at 26 levels to monitor. Then if we have monthly on top of that, now we have 39 numbers in front of us to monitor each and every day. And I got news for you. I think I have found a better way of trading without that type of information overload. Now, here's my rule of thumb for pivot points and how to use them. If the market goes through my daily targeted R2 or my daily targeted S2 number, in other words, the second resistance or the second support, I use the weekly and monthly numbers to give me a better indication for the next major target level of support or resistance. Now, if we go through, as it says here, if all of the above are breached, in other words, if we go through the monthly R2, the weekly R2, and the daily R2, believe me, R3 numbers aren't going to help us. In that scenario, I would incorporate longer-term Fibonacci price correction or extension studies, and we go over how to do that later in this presentation. Now, more importantly, on a normal given day with adequate liquidity, not a lot of price or news-driven price shocks to the marketplace, I initially take R1 and S1 is what I anticipate to be the potential range of a given time frame, and I do that for all my analysis. That means my daily, my weekly, my monthly. So now if you think about it, I've got 2 numbers for the day, 2 numbers for the week, 2 numbers for the month. I've got 6 numbers versus 39. So, especially I use that methodology when we're in low volume or consolidating trading sessions. Now, the pivot point. Remember the pivot point? The high, the low, the close, added up, divide by 3. That can also be used to determine the actual high or low of a given time period, especially in strong bull or strong bear market conditions. So, that's worth repeating. Let me go through it again. In an extremely bullish market condition, the pivot point, which once again is the high, the low, the close, added up, divided by 3. So the pivot point can become the target low for that trading session. In an extremely bearish market condition, the pivot point will act as the target high for that trading session. So now we have pretty much in any environment, we have 3 market direction trends or conditions.